here's a fun fact. If you had invested just $100 in US stocks back in 1928, that money would be worth nearly $800,000 today. That's the power of starting early and letting your investments grow over time. Now imagine what $1,000 invested in 2025 could become in the decades ahead. The truth is, you don't need to be rich to start building wealth. Even small, consistent investments can add up, thanks to the magic of compound interest. But if it's so simple, why do so many people hesitate to get started? Let's talk about what really holds most new investors back. The truth is, fear plays a huge role in keeping most people from building real wealth. It's not just about being cautious, it's a deep psychological response called loss aversion. Studies show that losing money hurts about twice as much as gaining the same amount feels good. That's why the idea of risking your hard-earned cash in the stock market can feel so uncomfortable, even when the odds are in your favor over the long run. This fear didn't come out of nowhere. For most of human history, taking risks with your resources could mean not surviving the winter. Our brains are wired to avoid loss at all costs, and that instinct still kicks in today. So when you think about investing, it's natural to picture all the things that could go wrong. Maybe you've heard stories about people losing money in market crashes, or maybe you just don't want to make a mistake and regret it later. These worries lead to hesitation, and for a lot of people, doing nothing at all. But here's the thing. Leaving your money in a savings account isn't as safe as it seems. Sure, it feels secure because you can see your balance and know it won't drop overnight. But with interest rates so low, your money is actually losing value every year thanks to inflation. In the long run, playing it safe can be riskier than investing, because you're missing out on the growth that comes from putting your money to work. A lot of new investors also get tripped up by the myth that investing is just like gambling. But there's a big difference. Gambling is all about chance. The odds are stacked against you, and you have no control. Investing, on the other hand, is about making informed choices. You can research companies, diversify your investments, and use strategies like dollar-cost averaging, where you invest a set amount at regular intervals. Another common misconception is that you need a ton of money to start. In reality, you can begin with just a few dollars thanks to fractional shares and low-fee platforms. And you don't have to go all in on risky stocks. You can start with low-risk options like index funds, government bonds, or high-yield savings accounts. The real breakthrough comes when you take that first step, no matter how small. Investing isn't about chasing quick wins, it's about building habits and letting time do the heavy lifting. Even a modest investment can help you shift your mindset from focusing on what you might lose to seeing what you can gain. Like building a workout routine, the hardest part is getting started, but each step forward makes it easier to keep going. If you're still on the fence, remember that the biggest risk might be missing out on years of growth. The earlier you start, the more time your money has to compound, and that's where real wealth is built. Let's talk about what happens when you actually put $1,000 to work for your future. The secret isn't about finding a magic stock or getting lucky. It's about using the power of compound interest. This is the principle that lets your money earn returns, and then lets those returns start earning returns of their own. To see how this plays out, consider what history tells us. The US stock market has a long track record of growth. For example, $100 invested in a broad market index in 1928 would be worth close to $800,000 today. That's not just luck. It's the result of compounding and sticking with your investment over the long haul. So if you put $1,000 into the market in 2025, what could happen? If the market keeps up with its historical average, about 10% a year for the S&P 500, your $1,000 could double in about 7 years. Let it ride for 20 years and you might see it grow to over $6,700. If you're in it for 30 years, that single investment could be worth more than $17,000. Of course, real life isn't always so smooth. Markets can drop, inflation eats away at your buying power, and you'll have to deal with things like taxes and fees. But here's what's important. The longer you stay invested, the less those short-term swings matter. Over decades, the market has always bounced back from downturns. People who stuck with their investments through rough patches, like the 2008 financial crisis, often saw their portfolios recover, and then some. Now let's look at what happens if you make investing a habit. If you put in $1,000 every month for 30 years, and you earn a reasonable 6% annual return, your total could grow to over $1 million. That's not just from your contributions, it's from your money earning money, year after year. Consistency is key, even if you can't always invest the same amount. It's also worth noting how much starting early matters. For example, a 25-year-old who invests $10,000 at a 7% return and leaves it alone until age 65 could end up with more than $147,000. But if you wait until 35 to start and try to catch up by saving double, you might still fall short. The extra years make a huge difference because of how compounding speeds up over time. That's why time in the market almost always beats trying to pick the perfect moment to invest. Choosing where to invest $1,000 in 2025 comes down to understanding what each option brings to the table. With so many choices, stocks, ETFs, index funds, and even cryptocurrencies, it's easy to feel overwhelmed. Let's look at the stock market first. Picking individual stocks can be tempting if you want big wins, but it takes time, research, and a strong stomach for risk. If you'd rather avoid betting on one company, exchange-traded funds, or ETFs, offer a simple way to spread your money across a wide range of businesses. For example, an ETF tracking the S&P 500 gives you a piece of 500 top US companies. Historically, the S&P 500 has returned over 10% annually, and experts like Goldman Sachs expect continued growth into 2025, projecting about a 9% increase for the year. ETFs also help protect your investment by lowering the risk that comes with putting all your eggs in one basket. If you're curious about other options, cryptocurrencies like Bitcoin and Ethereum are still in the mix. They've made headlines for wild price swings, and some believe they hold long-term promise. But crypto is a different beast. Its value can jump or drop overnight, so it's smart to only invest money you can afford to lose. Now let's talk about index funds. These are mutual funds built to mirror the performance of a market index, like the S&P 500 or NASDAQ 100. Getting started is easier than ever. Many online platforms let you open an account and invest with as little as $1,000. Fractional shares make it possible to buy into even the most expensive stocks or funds, so you don't have to wait until you've saved thousands. The most important step is just to begin. Whether you go with ETFs, index funds, or a mix, building the habit of investing is what counts. When it comes to building wealth, starting early makes the biggest difference. Even a single step, like investing $1,000, can open the door to long-term growth. The key isn't how much you start with, but building the habit. Consistent investing, even in small amounts, adds up over time thanks to compounding. If you're ready to take action, open a low-fee brokerage account and set up a $50/month automatic ETF purchase to get started today. Let me know below which option you'll start with, ETFs, index funds, or crypto. Subscribe for weekly tips on building confidence and smart investing strategies.